We often see angel investors, venture capital firms perhaps bring another facet to the table, which is some coaching and some guidance to help early stage companies grow. How does crowdfunding perhaps bring other facets to an entrepreneur?
Yeah, so equity crowdfunding not only provides the benefits of the additional capital that's contributed to the companies, but one of the main benefits is that it produces brand champions. And those brand champions can really go out there and amplify the message that that company is trying to get out to new consumers and to acquire new customers. In addition, what we're really focusing on is bringing on those venture capitalists or those angel investors that will really drive and lead that round. So then what we see is we have the expertise and the coaching and the opportunity for those companies to use the network of the venture capitalists or the angel investors and get that additional support, but they also get the opportunity to reach out to their consumers and amplify their message, which is probably their second biggest hurdle that companies have to get over as an early stage company.
Public markets obviously have a lot of regulation and requirements around the types of companies that can list and be accessed by non-accredited investors. What are crowdfunding platforms doing to protect investors?
There's a lot of different safeguards and mechanisms in place to protect the investors when they are on the platform. There is a difference between what they call a regulated crowdfunding platform and a regulated investment platform. Now, FriendFunder, we're a regulated investment platform. So part of our due diligence requirements is to make sure that we go through each of the companies that list on our platform and make sure that they pass a certain level of know your product or due diligence screening that we take quite seriously. On the other side, when an investor comes onto the platform and chooses to make an investment, they have to go through a know your client process that basically gives us enough information to determine what their investment objectives are. And then when they go through and actually make that investment, we perform a suitability on that investment to make sure that it's in line and consistent with their investment objectives. And that helps to protect the investors, making sure that they have a diversified portfolio and they understand the risks and rewards that are associated when investing in early stage private companies.
If we think about the entrepreneur now, and the established business that may be looking to raise finance and is perhaps looking at crowdfunding as one avenue and the more traditional sources of financing, say venture capital, private equity, or even bank debt as an alternative. What are some of the different things that they perhaps need to consider in terms of working with a crowdfunding platform like FriendFunder compared to, say, a traditional venture capital firm or private equity firm?
Yeah, I think lots of different investors bring a different set of skill set, and no different with the crowd and the retail investor who's coming to the table. They can bring a different benefit to that company. One is the financial wealth that when pooled together, it creates a large amount that's beneficial to the company. But equally as important, and something that we really stress to our companies that we work with, is that we want that venture capital funding coming in as well as the retail investors. Because those venture capitalists or those angel investors or institutional investors bring a wealth of knowledge, expertise, and connections that they can help the company grow and succeed. So at FriendFunder, we really stress that we want both the retail and the VCs, and it's something that we're starting to see, and even VCs bringing different companies to us now to access that new pool of investors.